Hey guys, Whitney here. People are just now rolling in, so we'll give it a moment to let people join. Hope you guys are having a fantastic day. I know we are prepping for 4 feet of snow coming our way here in Colorado, so it's going to be an intense few days. Hopefully you guys are staying warm and dry where you are. Awesome. Well, I got a couple minutes past the hour. I will go ahead and get this rolling for us. This is another installment of our How to Get Started as a Passive Investor. Today, we're going to talk about property class. Like, what does that mean when you're looking at multifamily investing? But before I get started, if you guys have any question, make sure to find your chat box, jump on over there. Normally I ask, my first question is, can you hear and see me? If you can't hear me or see me, let me know, jump on over there. Yay, thank you, David, for the feedback. It's always great to know that you're being well received. Anyways, but let's get started. So if this is your first time attending one of these webinars, welcome. I do these to help you understand like what some of the biggest myths are in syndication investing, because there are 2 big myths that keep investors sidelined, and we want to bust through those. And today, specifically in today's presentation, we're going to go over the different classes of multifamily investments. You see, when I'm on the phone with investors, I get a very common question, like what does multifamily B class actually mean, or multifamily A? Like, is it the style of the property? Is it the age? Is it how much, the disrepair of the property? Like, what's going on here? Once we define these different classes, we're going to learn about the advantages and disadvantages of these classes and the impact of investing in each class on your portfolio. Like, essentially, how do you put together the strategy? But I do these webinars for you. Maybe you have tried to invest in syndications before and just got cold feet. You don't understand it. You're like, I don't know what I'm doing, okay? Or maybe you invested in syndications before and went, oops, I maybe made a mistake here. That's totally fine. This is what we specialize in is education and making sure that you are 100% comfortable before moving forward on an investment. Or maybe you just felt so overwhelmed by all the information out there that you just never actually got started. You're just like, I don't even know what to do. How do I start putting together the strategy and plan? If any of these situations fit you, you are in the right place. But let's bust through that number 1 myth. So there's 2 big myths. Okay, we've talked about the other myth quite often in the past, the past few weeks, and that's control. But the second biggest myth of syndication and investing is that investors believe that if I invest in a syndication rather than my own single family or small multifamily investment, I just won't make that high of a return. And that's just entirely not true. That mindset keeps so many investors from getting started. Okay, you see, because in syndication investing, there is a high return on the money. We are going to talk about that as it relates to property class today, but there's so many other returns that come from syndication investing. You get return on your time, return on your investment in the company that you partner with, because you get to leverage their knowledge, expertise, market expertise, their team, their ability to secure lending, their credit, and other investor money to invest in these large, high quality assets. Okay, so it isn't all about the money. I get it. There is a higher return here that we're talking about. And this is something I'm super passionate about, because if you guys know me, know my story, I mean, these guys are the whole reason why I invest in syndicated investment, but it's not just them. Take a look at where I'm at. This is where we spent our December this year. We spent the whole month of December in Arizona just because we had the freedom and flexibility to travel, and we got to mountain bike and play and just hang out. It was so awesome, especially during COVID. We just needed to, I guess, how did I put it to my husband? We need to look at different paint on the walls. So anyways, but this is the reason why I invest, is, to have the freedom and flexibility to be where I want and do what I want with whomever I want. And so, but that wasn't always that way. I started off in real estate investing in 2002, doing live-in flipping and house hacking. And, at that point in time, it was all about making large buckets of money, like equity growth. And but I didn't have that time freedom back. I didn't have financial freedom. My investments could not cover my bills. It was a painful experience, and it took me many years to really figure out my path and way through. And really, it was when I stumbled upon, small rehab investing, BRRRR investing, as it's called, and then how I could leverage those BRRRRs and invest in syndications. That is when my portfolio really exploded. And fast forward, Goodyear or Goodegg is coming up on its third birthday. So I'm going to get to change this number here in a couple weeks. But, we as Goodegg in the past 3 years have invested in over 26 multifamily properties. We have over 6,700 multifamily units under management and an $800 million portfolio value. And that is just through tons of hard work and dedication. But what I get to do on a daily basis is work with you guys, our investors. And that is just something I love and I'm super passionate about. So let's dive in here, okay? Because you guys aren't here for me, you're here for you. So let's do a quick recap of the things that we've tackled to date before we dive into today's topic. But of course, like every webinar that you attend on like personal finance or real estate, there is a little bit of a disclaimer here. What we're talking about today is for educational purposes only. If we get into any additional kind of tax, legal, or financial question, you have to consult with your professional team and understand how this information applies to your specific scenario. But I invite you, ask those questions, put them in the chat box, and let me help guide you and, and point you in the right direction. But if you're here and you're just getting started, take a screenshot of this page. This is just, kind of like the top 10, 11 videos that I really suggest people, watch. You're going to get, this video is being recorded. You're going to get a replay email. And if you scroll down that replay email, there's going to be links to several other webinars that I've done. Watch these webinars first to get your base education on syndication investing and more specifically how we do it here at Goodegg. All right. So today we're talking about multifamily class. What does that actually mean? You hear the class terms, class A, class B, class C. It makes you feel like it's grading, right? Well, it is in a way, but how are things being graded, right? If we think about, class A, you would think of somebody who has a checklist and they have like all these parameters, and the more check boxes like an investment gets that meets those parameters, it gives it an A. Not true. When we're talking about multifamily investing, generally the classes are defined by the age of the building. So class A is usually our buildings that are less than 10 years old and, are newer and more upscale buildings. Now, it doesn't necessarily mean that they are a luxury apartment building, but a lot of class A luxury builds were built in the last 10 years. So those terms are somewhat interchangeable right now. Now, class B, they're about 10 to 25 years old. They're pretty much well maintained. There's probably no obsolescence or deferred maintenance on them. They're still located, pretty well to city centers because they're probably, in right outside the city center, maybe in a secondary market. Okay, so they're still well situated. They're affordable. They're workforce housing, and we're going to get more into the pros and cons of each class. All right, class C. These buildings were, built, probably 30 to 40 years ago. And so these, they might have been maintained pretty well, but, they definitely probably have a different build structure to them. And then there's also class D. Now, class D, this is where you're going to find more of your people that are on Section 8. And Section 8 is just, really defined as fixed income type housing. These are generally government subsidized housing residents. And you tend to find those more in lower socioeconomic areas. So this is just our basic definitions that we're going to work off of. But the reason why you need to know the definition, the various definitions, and what investment class you are actually investing in is that each multifamily property class will have advantages and disadvantages. They're going to have different business plans, right? When people ask me what are the risks of real estate, investing in a syndication, well, one of the things you have to understand is what is the business plan, and we're going to talk a little bit about that because each type of business plan actually has a risk to it as well. And putting together advantages and disadvantages and this business plan risk, will give it an overall risk reward profile for that class. Now, I do have to put like a caveat on here. Some of the classes are going to be, market dependent. Okay, so a class B property in Kansas City might operate much differently than a class B property in Dallas, Fort Worth area. And so there is some market, some things about the market that can really impact that. But we're going to set that aside because when we look at our markets, what we invest in here at Goodegg Investments, we are looking at growth markets. So we're looking for, a certain type of market where population's growing, jobs are growing, incomes are growing, jobs are diversified. We're looking for favorable tax profile, favorable landlord-tenant profile, and stuff like that. So our markets are generally going to be pretty much interchangeable when we talk about our classes. All right, so let's talk about the pros and cons of each class in the business plan. So class A, I'm going to call this, for all intents and purposes, more of what we call the hold type investment. Okay, so for class A property, remember it's 10, newer, probably less than 10 years old. The average rents of this property are going to be pretty high. Now they could be high like luxury rents, maybe $3,000 or $4,000 because you have huge amenities, you got a gated community, you maybe have a golf course associated with that particular area, or maybe it's a workforce housing type scenario right outside the city center. Maybe it was an old textile building that got renovated and it's class A because it was just renovated in the past couple years, right? But class A buildings, you're going to be able to charge more for rent. There's a higher perceived value here. They're still generally located in desirable geographic areas, right? People are, if there's an exchange of value, if they're going to pay a high rent, they want a high exchange of value. So they're going to be in a desirable area. The tenant base is probably going to be, because of the higher rent, going to be more aligned with the white collar worker. And they're going to be renters by choice, okay? For various reasons, okay? But that works well for us in our business plan. These type of assets generally yield pretty stable cash flow, okay? Now, I put often low, and I'm not saying low bad, it's just that you're not gonna get huge rent premium jumps at this type of asset. Maybe you can push, rents like $20, maybe $50 upon renewal, but the value has already been consumed by the previous entity, the previous business owner. Either maybe it was a developer that you bought it from, or probably a developer that you bought it from, somebody who rehabbed it and already kind of moved the property to market rents. So you're going to have stable cash flow, but often a very small or low rent premium that you can capture. Now that leads me into the disadvantages. There's less opportunity here to move rents on these type of properties. One of our properties in Tampa, when it's a B class property, I'll talk about this in a second, we're achieving $200 rent premiums on that property. However, on these type of properties, you're generally not going to get that. It's going to be smaller rent increases over time. There's also probably a less of an opportunity to decrease the expenses on the property because the expenses is probably operating already pretty darn efficiently. And there's generally going to be less of an opportunity to add additional streams of income on these type of properties. So that's why I say it's not a value add situation. This is going to be a hold. You're buying the property for stabilized cash flow and moderate equity growth. So who likes this type of asset? Well, basically entities or people that need just to have stable cash flow and don't want to get into any like long-term capex or maintenance type issues. Let's think about this. Banks, insurance companies, REITs, okay, they love this type of asset. Okay, so this does have a risk reward profile for just stabilized cash flow and generally, less headaches when it comes to maintenance or repair risk. And there is no value add business plan to implement on this type of property, so you remove that business risk as well. That leads me into the Class B value add property. This is like our bread and butter. I really love this because it's workforce housing, there's affordable rents, we're targeting largely the middle class rental base, and a mixture of white and blue collar workers. This building is generally still well situated to the city center, and probably right outside the primary city center or in the secondary market. And this type of housing is in short supply. And why is it in short supply? Because we're not building this type of asset anymore. That land has already been developed in that particular area, so we really already know who the competition is. All right, and I'll talk about that here in a second. But this type of building, it's dated, right? We might consider that a disadvantage, but for us in our business plan, we consider that an advantage because there's more opportunity for us to pull what I call the 3 NOI levers. And what are those levers? Moving the property to market rent through a cosmetic rehab, decreasing expenses on the property. Okay, we're usually acquiring the property from an operator that is maybe a little tired and hasn't renegotiated utilities or vendor contracts or anything like that for a really long time, so we can capture operational efficiencies. And the third lever is that we can actually add additional streams of income and rework the amenities on the property to bring it up to the competition level. Okay, so those are all advantages for us, and that is the advantage of the business plan. Now, what are the disadvantages? Okay, you have to make sure that this building is in a good market and submarket that's in a path of progress, right? That the city is going to continue to invest dollars in that area and that people want to move. If it's not in an area where people want to move to, that in migration is actually happening, you got a problem. You're on the wrong side of business growth. Okay, so you want to make sure when you're underwriting this type of building that there is a demand for people to move into that area for the next 10, 15 years. We also need to make sure that this tenant base is really well underwritten, okay? And especially right now during COVID, we want to make sure that, the operator is doing a lease audit and looking not only just at the leases, like are all the leases in line, but digging into like, what are the tenant financials? What is the stability of their job? What kind of job do they have? Is it hourly? Is it salary? What is the job title? Even so far as maybe even checking out the company that tenant is, that current tenant, the one that you're inheriting, is their company hiring or firing? Like, we want to make sure that tenant base is really well underwritten. Now, that's part of our due diligence process. And that also gives us insight to what type of tenant base we would continue to expect to pull onto that property. The other disadvantage, okay, it depends on which side of the coin you want to look at here, is that the business plan on this asset requires you to keep the property updated to the level of the competition in order to excel on this business plan. Meaning, layout of the properties, okay? So that's why when you buy a value add B class building, you want to make sure the layout is already, the layout of the units are great, okay? Because you can't really move walls that efficiently. You don't want to get into that type of that type of expense, construction expense. You want to make sure that you can update the properties for just a couple thousand to maybe $6,000 a unit, and that it's very cosmetic. You don't want to get into moving walls, moving electrical, any of that type of work, okay? Because again, you're going to introduce more risk with that type of construction. Okay, and that you want to make sure that the operator's business plan is to bring it up to the level of the competition in the market so they can stay competitive in the market. This type of property, Class B property, we consider it a very balanced approach between cash flow and appreciation, because you can actually achieve both sides of the coin pretty readily on this. Okay, this is for the balanced investor that needs some cash flow now and need some, relative good chances for appreciation. Now let's talk about Class C development. I'm not going to get into Class D at all. We're just going to stop here at Class C. I call this type of project more of a development type project. Now, you'll see some operators call it value add, That's totally fine. You can call it value add, but you want to investigate further on the value add piece, because you probably will find that it's closer to a light development type project. Um, Under advantages, you want to look for Class C. If you're going to invest in Class C, you want to look for Class C properties that are in Class B areas. Very important. Location, location, location. You want to be in that path of progress. Okay, you don't want to be in a Class C building in a Class C area unless the city is investing to bring that up to a Class B area. All right. This type of property generally has blue collar to low moderate income residents. I did put that under advantages because if you know your tenant base and you know how to work with them, you can still make this a very lucrative asset to invest in. Class C properties, there's generally more opportunity for pulling all three of the NOI levers as well, increasing, doing a cosmetic rehab, bringing the property up to market rents, reducing expenses, and adding additional streams of income. You just want to make sure that there is opportunity in the market for you to capture those increases. Okay. If your tenant can't afford it and you can't attract a new tenant that wants to live there and pay for this type of value that you're putting on the property, you're behind the eight ball in your business plan. So disadvantages, what do you need to watch out for? In Class C properties, very common, you need to watch out for obsolescence. And specifically on the projects I've been involved in personally in my own Class C properties in my portfolio, water, sewer issues, roofing issues, and foundations. Those are the ones that are gonna get you in a pickle pretty darn fast. So galvanized piping. That is something that we find on Class C properties. Has it already been taken care of? What's the plan to get it taken care of? Do we expect to see issues on the property for that type of thing? Again, I already touched on this. Another disadvantage, you want to make sure that the asset is in a path of progress. Okay, this is not the opportunity. You're high risk, high reward. If you get a Class C building in a Class B area and you knock this business plan out of the park, you can see some high cash flow and high appreciation on this asset. That's amazing. It can also cut the other way pretty quickly as well. And on Class C properties, you want to make sure that the tenant base is very well underwritten. And you want to make sure that the operator has accounted for economic vacancy. Right now, Class C properties, and I'm not going to it sounds like I'm making a generalization. I'm not. But there are many Class C properties that are experiencing a higher economic vacancy rate. So you need to make sure the operator is accounting not only for physical occupancy or physical vacancy, but also the economic vacancy. And that they are doing that for at least another 1.5 to 2 years, right? So we can work our way through this crisis that we're in. Now, you want to make sure that this property, this Class C property, if you're going to invest in it and it's in a Class B area, that it can actually compete to its Class B competitors. Now, it doesn't have to have like the luxury swimming pool or dog parks or anything like that, but you want to make sure that you are pricing it accordingly and setting your expectations reasonably, that it can compete with these Class B properties. All right. If your business plan hinges on a Class C property in a Class B area, being able to achieve that Class B rent, that institutional asset that's across the street, you're probably not going to get there. But if you could bring it up to a level of competition and maybe be $100 cheaper than that Class B asset across the street, you're going to have people that want to be in close proximity to that asset, but still be in that area, whatever that area is defined as, and they'll be happy to pay more to be in that Class C property and feel like they're saving in amenities over the Class B. Hopefully that makes sense to you guys. Now, what do we do? Well, here at Goodegg, we have a very simple investment philosophy. Our number one value for our investment philosophy is that we preserve capital. Okay, if you invest with us, we are investing in projects very conservative projects that are going to preserve capital. Okay, Warren Buffett's rule number one: don't lose money. Rule number two, see rule number one. We also love assets that love cash flow. Okay, that have cash flow on them. They're stabilized. They're cash flowing right now, even if we did no construction to them at all. And we want to have a reasonable chance of appreciation. Okay, and then tax benefits. It's real estate. We love tax benefits as well. So if you guys haven't figured it out, our love is the Class B value add asset. We also will do the Class A asset as well. So Class Bs are bread and butter. That Class A hold asset, we will also offer that as well. So that was a huge, hopefully I went in depth. Hopefully you guys now understand what it means when you see Class A, Class B, or Class C on a deal alert from us, that you guys understand that it's based on the actual vintage of the property, not necessarily, you know, what kind of amenities are on the property, but the vintage of the property. But what are the advantages and disadvantages? Which type of the class probably works best in your portfolio? You don't have to just pick one, right? Diversification, maybe pick two or maybe all three of the asset classes and diversify them and balance them out in your portfolio. Again, one's going to be more stable for cash flow. One's going to be more stable for appreciation, or you could have a higher risk, higher reward profile for appreciation. And then you got Class B that's going to be a balanced blend of both. So you guys jump over the chat box. If you guys have any questions, let me know. And if you haven't already applied to the Goodegg Investor Club, make sure you do that. If you want to be on our deal flow list, we got to work through the process, hop on a call, or actually get you to apply, hop on a call with you. And the Goodegg Investor Club is for anybody that's just starting out investing, doing this on the side, hasn't done a deal yet. Or maybe you're an investing pro and you just want to expand your deal flow and you've done several deals under your belt. Make sure to jump on over there. And as always, I want to know what you guys want to know about. This topic actually came to me from an investor on this call, so that's amazing. So what topics do you want to see covered? Let me know that as well. Yeah, absolutely. You guys jump over the chat box, drop in your questions, and I will answer them. So, and if you need to bug out, thank you so much for spending your most precious resource with me today, which is your time. Here's my contact information, and then I'll put up, if you're just looking to get into our deal flow, jump on over here to Goodegg Investments and apply there. Thanks so much for joining me today. If you got any questions, jump to the chat box.